What happened with Silicon Valley Bank, as simple as possible, was they had a bond problem. But unlike James, these bonds are not that cool. They are really low risk and pretty boring. Think US Treasuries and mortgage bonds. Now, we know that banks don't just store all of our money in a big safe, right? No, they take it and they invest it. They put the majority of our money in these boring bonds. And that's not usually a problem unless everybody tries to take out their money at once. SVB is a bank for startups and VC companies, and in the past 5 years, startups have gotten a ton of money. So SVB's deposits have gone up really far, really fast. And that also means that during that same time, they bought a lot of bonds at a time when rates were really low, and that's the important part. Fast forward to 2023 and startups are in a different world. It's a lot harder to raise money, so they have less cash on hand, so they have to start dipping into their savings. And remember, SVB only has a certain amount of cash, a small amount of cash, so they realize they are going to have to start selling some of their bonds to fulfill these withdrawals. But the golden rule of bonds is that as rates go up, the value of those bonds go down. And SVB bought a lot of bonds when rates were really low. Rates are much higher now, and they ended up losing billions of dollars selling off these bonds. Once this news broke, even more of their clients panicked, tried to pull their money out, and then the 16th largest bank in the country collapsed. The good news is the government stepped in and is making sure that everybody who banked with SVB is getting their money back.